So looking at the second of the government policies that are contained within the course, and this is another demand-side policy, monetary policy. So we need to know what monetary policy is. We need to know how it can affect aggregate demand and aggregate supply, and how they can affect unemployment, how it can affect economic growth, inflation, the current account position, and how effective it can be in achieving the government's objectives. So monetary policy is defined as decisions by the central bank or government on the rate of interest, the money supply and the exchange rate. Now primarily for your exam you're just looking at the rate of interest, but more recently some governments have been engaging in increasing the money supply through quantitative easing, and some governments do engage in kind of changing their exchange rate, fixing their exchange rate, devaluing their exchange rate usually, but our government doesn't, and the specification just really requires you to have knowledge of changes in the interest rate and how they affect the economy. So let's have a look at these in turn. My computer's frozen. Is it going to stop freezing? Who knows? There we go. Okay, so the central bank sets the official interest rate, which is called the base rate, and this affects the economy because although we don't have, or I don't have, a bank account with the Bank of England, because you know it's not a kind of normal bank for normal people. It's a bank that lends to other banks, and therefore it'll determine what rate the the banks that you have your bank account with, say NatWest or Barclays, set their interest rates at. So although it doesn't directly determine the interest rate that I pay on loans or mortgages or my overdraft or that I get on my savings, it influences it. So if the interest rate increases, borrowing becomes more expensive, because the interest rate is cost of borrowing. Saving becomes more rewarding. If you already have a loan at or a mortgage, those repayments become more expensive, and it also causes the pound to appreciate. Remember, with the hot money flowing into the country, so exports appear more expensive, imports appear cheaper, and what that means is that consumer spending, investment, and exports decrease, whereas imports increase, which causes aggregate demand to decrease. And if the interest rates are decreased or reduced, the opposite would happen. So looking at the money supply on the next one. My computer's being very slow tonight. Here we go. It's the printing of money or making it easier for banks to lend more money. So if we increase the money supply, it's easier for people to borrow money. And we also get, here's a micro diagram of the exchange rate. If we increase the money supply, we also get a depreciation in the currency, and that has an effect on exports and imports. And so we get these factors as well happening, similar to the interest rate being decreased. And then the opposite, if you have a credit crunch, if there's some money supply, if people aren't lending to each other, as in people, I mean banks, then you get the opposite happening. This is a link to a video from Bank of England about explaining quantitative easing, because it's a way of adjusting the money supply. The exchange rate as well, if you intentionally intervene in the exchange rate market, so dealing in foreign exchange, or intentionally setting the interest rate to influence the exchange rate, that's a form of monetary policy. So if you have exchange rate appreciation, we've already kind of really been through that. It makes exports more expensive and imports cheaper, or appear cheaper, and therefore demand for exports reduces, demand for imports increases, so AD reduces, and you can see the opposite happens if you have exchange rate depreciation. So you have two different types, therefore, of monetary policy. There's two different things you could do. You can either increase AD or you can decrease AD. So expansionary or reflationary monetary policy is where you either reduce the interest rate or increase the money supply or depreciate the currency, whereas deflationary or contractionary monetary policy would be increasing the interest rate, reducing the money supply, or appreciating the currency. So, I mean, technically, when you're actually directly trying to change the exchange rate. You call it devaluing, not depreciating, but just a bit of a fact there for you. I've forgotten off the top of my head what it's called if you do it the other way. But it's 7 o'clock on a Thursday evening. It's been a long week. So the effects of this diagram here, the expansionary, so increasing aggregate demand, is it increases real GDP, reduces unemployment, because obviously labour is derived demand, so the more output that there's demand for to produce, the more workers you need, and it increases the price level, so we've got some inflation happening there. Obviously all dependent on the multiplier, the size of the shift, so the size of the reduction in the interest rate usually, and the original level of economic activity, because if you're here with a lot of spare capacity, you're probably not going to have very much inflationary pressure, whereas if you're near to full capacity, you're going to have much more. And then the opposite way round, when you're reducing aggregate demand by increasing the interest rate, usually you decrease real GDP, you're increasing unemployment, you're reducing the price level. So on this diagram it's showing deflation, but it's more likely to be disinflation. So it's the Bank of England, as I mentioned before, who sets the interest rate. They've got some lovely videos as well on their YouTube channel, so check those out about the job that they do and how they do that. So primarily the Bank of England, which is operationally independent from the government. So the government set their target of what they want inflation to be, but they're able to adjust the interest rate independently. They're not told by the government what level to set that interest rate at. And primarily they are in charge of trying to control inflation. So monetary policy is used primarily to control inflation. So if we have demand pull inflation, what we do with the interest rate is increase it so that it becomes expensive to borrow, rewarding to save, loan repayments become more expensive, we get exchange rate appreciation, and it should reduce aggregate demand or maybe slow. You might not want to reduce aggregate demand because you have some negative effects such as the increase in unemployment and the decrease in the real GDP. So what you might actually want to do is just slow the growth of that one. And this is what that would look like in a diagram. So just my computer's tired this week as well. So we've got AD shifting inwards, but in reality we're just probably just like trying to slow that growth of AD there. So obviously you reduce inflation, all those negative things associated with inflation, such as menu costs, you live costs, fiscal drag, uncertainty, loss of international competitiveness, all those types of things. But your side effects of doing that are that if you do it too much, obviously unemployment, real GDP reduces. You possibly as well can cause a bit of cost push inflation because you're increasing firms' costs by increasing the interest rate, so their loan repayments, because they'll have loans as well, become more expensive. Yeah, it's just explained there. So what should you do with monetary policy if you're trying to control cost push inflation? Quite different actually. You can what can you do? You could reduce the interest rate to try and lower firms' cost of production. But the main way that the government control cost push inflation is through setting an inflation target. So we have a target of CPI 2% plus or minus 1%. So it's between 1% and 3% our target inflation. And if consumers and firms know that there is a target and people expect inflation to be at the target, workers demand wage increases that are in line with the target, and businesses put prices up in line with that target. And so therefore inflation tends to, it's like a self-fulfilling prophecy, because people think inflation is going to be at that level. It encourages it to be at that level, and therefore cost push inflation is controlled. And lots of governments have found this a very effective method. I think we only set a target for inflation around about I was going to say 97, but that's actually when the Bank of England, or 97, 98, gained operational independence. We might have been toying with an inflation target since the early 90s, but I can't remember because I was very young at that time. But it's something that's relatively recent. You know, we've not had it for 80 years, 100 years. Something a relatively recent concept that countries have inflation targets. You learn a bit more about this in the AT course as well. So what should you do if you want to reduce unemployment or encourage growth? So you're going to want to use expansionary monetary policy. So you'd want to decrease the interest rate. So we get all of these things happening. This is our level 3 analysis there, and the effect is that it should increase aggregate demand, and this looks like this on a diagram. But the side effects would be, and make sure if you're talking about unemployment, you really explain why an increase in aggregate demand leads to a reduction in unemployment and an increase in employment. And it's because to produce that extra output that's demanded, you need workers to produce it, because labour's derived demand. But your side effects are you get demand pull inflation. And you get some negative effects from demand pull inflation. Just inflation in general, we don't like that. There's also a limit to growing that way as well. Hopefully, maybe if you reduce the interest rate, you might cause, in the long run, aggregate supply to shift outwards, because there might be more investment, so increasing the quality and the quantity of capital. But it's not sustainable to just grow through growth in aggregate demand, because there'll be an eventual limit. So you really need aggregate supply to increase for that type of growth. Okay, and then how would we improve the current account? Well, we'd want to decrease it, wouldn't we, with the interest rate, so that we have depreciation caused of the exchange rate. And so price of exports decrease, price of imports increase. This isn't in real terms, this is relative terms. They just appear to be more expensive. And then this little trade balance on the end would improve. And it would look like that, because it would push aggregate demand up. But it causes demand pull inflation, and it could cause cost push inflation as well, because it could be that with the appreciation you're causing the price of imports to increase as well. So that should be a short run effect, but it can cause cost push inflation. We do import quite a lot in this country as well. A lot of our producers are dependent on raw materials being imported from a country. So don't just assume imports are like a bad thing, because it causes, this imbalance on our current account, and it means that, yeah, technically it's a leakage from your circular flow of income, but it's not necessarily a bad thing. We need a lot of the imports to make the exports, and we need imports to make our life material living standards better. I feel that life is better with access to bananas. I think it adds something to my life. Okay, so is monetary policy effectiveness? Is it effective? What does its effectiveness depend upon? Well, it does take time for monetary policy to work through the economy. So they guess that it takes around 18 months to 2 years to work its way through the economy, and there's a bit of time that's needed to pick up on trends in the economy to see if are we heading for slightly too high inflation or slightly too high unemployment? What should we do with the interest rates? So it takes time to kind of spot those trends and then to act upon it. And really, you should be trying to forecast what the economy is going to be like in 2 years' time, and then alter the interest rate to deal with that. And that's hard. That's going to be really difficult. And people take time to adjust as well. If they're very confident about the future, they may not reduce their spending or investment, or increase. If they're not very confident about the future, they might not increase it or their investment or their spending, so they might not be very responsive. We also at the moment have historically low levels of interest set by the Bank of England. It's 0.5%. And it's a bit like, I saw this episode of The Apprentice a while ago. It was a few years ago, and they were trying to sell something, and it was the end of the day, and they were trying to sell this chair for £1 to a customer, right? And they were saying, it's £1, just take it, it's really cheap. And the customer's like, no, I don't want it. And so the person went 50p. And I just thought, how ridiculous. If they're not going to buy a chair, an actual chair for £1, they're not going to buy it for 50p. And that's a little bit like our interest rate at the moment. It's 0.5%. If people aren't borrowing money when it's that low, then putting it lower is not going to be an incentive to borrow more money. the reason that they're not borrowing money is other factors. It's not because it's not cheap enough to borrow money. So, you know, there's a limit to how low it can actually go. So let's look at a few questions that have come up on exams before. Discuss the extent to which a reduction in the rate of interest can be effective in increasing consumer expenditure and investment. Really straightforward, nice little essay question there. And discuss the effectiveness of lowering the rate of interest in order to stimulate economic growth. Another straightforward one. Those would be two very nice questions to get in the exam. So all of those factors covered there. It is likely to be an essay question when it comes up on your exam. So revise.